Welcome to Tim Talks Private Equity and Venture, where Tim Cunningham sits down with leading GPs and private markets professionals to explore the dynamic world of private capital. Since 2002, Tim and his team at Touchstone Group have been at the forefront of raising capital for buyout, growth, and venture funds. With decades of hands-on experience working alongside private equity and venture LPs and GPs, Tim brings deep industry insight and expertise to every conversation. Join us for candid discussions with GPs who are shaping private capital today. Now here's Tim.
Welcome. It's another edition of Tim Talks, and today we got a really exciting guy, Chen Yu. Chen is a managing partner with TCGX, TCG Crossover, which is a biotech firm that unusually is investing in both public and private biotech companies. And there's a bunch of interesting structuring and other sorts of deal-related stuff around this practice, which is quite unusual. And lots of institutions can't figure out how to handle a strategy like this, but Chen has had no trouble raising capital. And so we're going to hear the story directly from him. Chen, welcome.
Tim, thank you for having me. Really appreciate it.
So maybe you could start with just giving us a little of your background. I know you've got an MD and some other academic credentials and so forth, but where'd you come from? How'd you get into this business and all that kind of origin story stuff?
Well, like many people, you end up in this business oftentimes by accident. So I'm a physician by training. I ended up dropping out of medical school in my third year, did a tech startup of all things that I was actually fortunate enough to be successful with. So we went public, ended up getting acquired. But I really wanted to return to my roots in biotech. And so ultimately, I went to Stanford for business school and then ended up at a small venture firm at the time called Vivo Capital. We were a small $60 million fund. And of course, the next 17 years really grew that fund to about $5 billion or so when we left, when I left. And then started TCGX, basically along the lines that you mentioned around this kind of hybrid model of doing both public and private within the same vehicle that certainly at the time was quite unusual.
How did you transition? What inspired the transition from Vivo to TCG? How'd that work?
Yeah, it's one of those things, with every firm at some point, sometimes it's time to move on. And so with TCGX, it was an opportunity for me to start my own firm and really kind of lay an imprint on the strategy that I wanted to pursue. And, to your point, frankly, over, that 17 years, I had learned and discovered there were certain kind of arbitrary structures or maybe forces in our business that led people to essentially invest in biotech in what I considered a suboptimal way. And so one of those big inefficiencies was this notion of what I call fixed mandate funds that do predominantly either public or private, despite the fact that almost everyone in biotech knows that small cap biotech companies that are public are almost the exact same as those that are late stage private. And so despite the fact that the companies were the same, we also knew that the risk reward of investing on either side of that ledger changes a lot on market conditions. So if you believe those two things, a fixed mandate fund that only does one or the other is almost a guarantee that at some part of that market cycle, you're basically going to be deploying capital on the wrong side of the ledger. And so right. I said, well, why would we want to do that? So that was really the kind of the notion that really started TCGS.
Yeah. So this looked like an anomaly where value is being created and enjoyed by different sides of the market here. And you decided there was a place kind of in the middle, well, on both ends of the barbell, if you will, and moving things from one to the other.
That's right. In general, if you think about hotter markets in biotech, the risk reward tends to favor the private market because you can invest in that late stage kind of we call it crossover round. You can take it public quite quickly at a nice step up. And by definition, if it's a hot market, you kind of trade well after market. And so that's why during the boom era, you saw a lot of public investors move to the private market during that time. But then you flip it around. The last 4 or 5 years in biotech have been quite challenging. And so not a lot of IPOs, right? Public markets are basically selling at 50% off. And so you start saying, well, gosh, when I look at that market, the public market looks like the cheaper, better risk reward opportunity. And so that's kind of my point. Like, let's say, for example, if you're an investor right now, I think one could make a very strong argument that investing in earlier stage biotech right now is a losing proposition. And so you'd say, well, if you're a private fund, you might actually consider not doing anything for a while. But we all know LPs don't pay GPs to just sit on their hands for 3 years.
Well, if you're collecting a fee to do that, it's not very easy, right?
That's right. That's right. And so you end up being forced to make what I consider like suboptimal investment decisions. And the crazy thing about it is that everyone knows it. The GP knows it, the LP knows it, and is almost like powerless to stop themselves. And so, that's why I think, for me, a hybrid fund structure is just frankly a logical extension of something that we all know.
Yeah. So how did you persuade LPs with their bucketized allocation list where they've got something for privates and something for publics, and usually they're different teams, different people making those decisions. So curious about how you were able to pitch this. Makes perfect sense, but things that make sense don't always market well.
That's right. And in fact, that's exactly the reason that most GPs don't do what we did, because it's just a lot harder to fundraise. So when I first went out, I have a joke. If I went to 10 LPs, 5 of them would just say no right off the bat. You just can't handle your structure, right? So what we ended up finding is that the LPs that were more compelled by our approach tended to be either A, generalists, so they didn't really bucket between public and private, or B, they were highly sophisticated in biotech. So they had kind of seen it themselves. They understood all these dynamics that I described. And so for them, it was a little bit of that aha moment, like, oh yeah, we actually know what you're talking about. We just have
they took it in stride.
That's right. That's right.
Yeah, interesting. So the generalists, in a sense, weren't specialized enough to know what the custom was. And the experts were sufficiently intuitive and informed to say, yeah, this is true. This makes sense.
That's right. That's right. And I would say this over the last 5 years where I think we've kind of validated the model, it's actually become quite interesting because I actually think the market is moving more toward us now than away. I think everyone has kind of come to this realization that it's a flaw. And people are trying to think now, well, okay, we recognize this as an advantage model. Now for the GP, it's actually an open question of whether they would pursue our model. Our model, just to give you a little bit more detail, we're a closed-end fund, right? Most funds in our space that are, especially ones that trade in the public markets, are open-ended in structure. And so for that piece is an interesting one, right? I always like to joke, how many GPs has an LP ever seen that converted from an open-end fund to a closed-end fund? My guess is the answer is 0.
Yeah.
So I think for all the obvious reasons that we know that compensation in an open-end fund is very attractive to a GP. You crystallize carry more frequently. It's better tax treatment. If you get into gory details. And so for us, I like to say as a GP, we have traded off a lot of the benefits of an open-end fund that accrue to a GP in return for a structural advantage that gets us better investment returns.
Yeah, we raised open-ended funds, hedge funds, which are really a manager compensation scheme with a liquid or semi-liquid market. And I don't know how else you can characterize a hedge fund strategy as being anything but that, because it's so diverse. So you've got liquid or semi-liquid and a manager compensation scheme. And as an agent, as soon as they become interesting to institutions of sufficient size, they get internal marketing. So because they're always open. So we cut that out more than a dozen years ago. Just not the same, the same culture. But biotech's different. If you take a pipe, some kind of nano-sized equity on the pink sheet somewhere, and you've got folks manipulating the hell out of it, and it trades by appointment, and it's a dicey place to be. But with the biotechs, you have this whole different timetable and pace and rhythm going on here, having to do with the various phase trials and the data that comes out of it and how the government's reacting to it and how the market's reacting to it. So it's not just this strange little orphan over here that's getting manipulated. And that really is that's the rep, right? That's the reputation for those pipes. So I understand why the institutions avoid it, but boy, you've cracked an interesting code. Are there other firms that are doing this now?
There are a handful of firms. I mean, I would say we are in close cooperation and competition with, firms like Ben Rock and Fraser. There are a lot of these funds. Well, one, I'd say, linkage between all of us is that actually all of us share a venture heritage, meaning we have other arms that really start off as true, I call it classic early stage venture investors. And I think that's important because, even though we often play in the public markets, our reputation is as a company builder and a partner as opposed to a trader. That's why I think it's like psychologically important that we don't typically buy and sell stock from other hedge funds. We typically buy the stock directly from the company. We're going to them, looking at their data, being partners with them, and just beyond capital. And that market is, of course, just much more constrained because most of the competitors in this market really are just trading, block to block from other funds.
So switching gears a little bit, just talking about your leadership style and how that's evolved over time, because you now have a fairly substantial money management organization. You're delivering on the promise. From the gritty early days to now, things must have changed. How has that evolved for you?
One of the things I think the truism in our business is that at the end of the day, you do well as an investment firm if you make somewhere between 15 to 20 good decisions a year.
Right.
And, you could be on a beach, make 20 great decisions and you'll make a lot of money, or you could work all day long, make 20 bad ones and you won't do very well. So one of the things that we spend a lot of effort on is indexing on a decision-making process that's very data-driven. And now, of course, that sounds obvious. But what I tell people is that if you think about decision-making processes, they're like living organisms. Because unfortunately, for better or for worse, we're people. We have feelings. And so you can put whatever you like on paper. But the reality is if you cannot create a process that has a lot of what I call polite dissent, you're not going to make very good decisions because you actually need that critical feedback. So, I've done a couple of things that were a little bit unusual. So, for example, even though I'm the founder, I actually stripped myself of the founder veto. And I felt that was a very important signal to say, look, the diligence is not meant to say, what is Chen like? It's actually, what is the right answer? And moreover, we actually make every single person on our team, all the way down to our junior analysts, vote publicly on every deal. And that
interesting.
That vote, it turns out, is also part of how we evaluate that junior team member. So now think of it. In a normal environment where your vote doesn't count, and frankly, you're just rubber stamping the deal because you don't want to get in the bad, get in the way of a partner, for example. Are you really going to read the memo? Because you got better things to do, right? Are you really going to, communicate your concerns? Not really. So all of a sudden, when you have to make a public vote, well, now you've got a positive incentive to engage. And it's actually in your interest to say, you know what? I actually don't like this deal because I'm actually going to put a feather in my cap by showing how smart I am. And all of a sudden, I think you get better feedback. And so one of the key performance metrics that we use is our hit rate. How often are we right on the technical read of that trial? And we're right so far the last 5 years, about 83% of the time. That's actually a very high hit rate in biotech. And I think a lot of that is due to like you kind of led us to, which is this decision-making process that really values dissent.
It's interesting. Ray Dalio has, you may have seen the principles and all of that. At Bridgewater, everybody's got a little scorecard. So they really push that method right down through the organization. It's interesting. We're very collaborative in our shop. I mean, we don't do anything unless everybody has agreed, and we frequently disagree and tussle over that stuff, which is great. These are debates, not arguments.
Well, I'm sure you've heard the saying, success has many fathers and failure is an orphan.
Right.
So,
well, no, but I think it's important to take ownership of your failures too, and to try and figure out why it happened. Sometimes it's you, sometimes it's not. But failure is part of it.
100%.
Personally, I find it important to focus on process and not so much outcome. if I do my process as hard as I can, as smart as I can, as honest as I can, what's going to happen is going to happen. And, it's just, I've got to keep pedaling the bike or it'll fall over.
100%. And that's actually part of the reason why, I had learned over the years, when the deal doesn't work out, you have everyone else say, oh, I didn't like that deal. That was Joe's deal.
Yeah, I didn't like it in the first place. Right.
That's right. And I said, well, look, if you had a problem with Joe's deal, I wish you had said it before, and that's really what I'm trying to pull out of this, was just to make sure that we surface all those concerns and make the deal lead answer those questions sufficiently. And when you go through that process, like you said, you learn things and you start to pressure test and you come to better decisions. I mean, that's the name of the game for us. And as I said, these are things that are very nuanced. I mean, even little things like, how do I make sure, like, Tim, if I'm telling you I think your idea is bad, how do I do that in a way that doesn't make Tim feel terrible about himself? And that's actually super important. So one of the things that we really emphasize is written communication. Is one of the things that I learned over time is actually it's very easy for me in the spur of a moment to say something I don't really mean, or it comes out the wrong way. But when you write something, it doesn't, you can police yourself so that you have time to process and think, and you can couch your feedback in a way that tends to be more receptive for the other person. So we actually spend a little bit of time thinking about how we communicate it as well. And that, at the end, for me, like preserving that culture of accepting feedback in an offensive way takes a lot of effort and a lot of work, but it's something that's very important.
Well, you have smart, bright, motivated people on your team. Obviously, almost nobody in this business is stupid and unmotivated. So, there's a lot of people who have self-governing behaviors. One thing I've found is really interesting is if you are a person who likes to be right, the quickest way you can be right if you're wrong is to admit that you were wrong, because then you can be right again.
That's a great line. I'm gonna remember that one. I think that's a great way of saying.
This is a way you can handle more junior analysts. You can tell them, look, you like to be right. I like to be right. We all want to be right. We can't be right all the time. You know how to be right all the time? Admit when you're wrong.
I love it. I'm going to use that line. I think that's a great way of expressing it.
Write that one down. So moving to the topic du jour, AI, not just necessarily how it's going to be used by you and your team, although I'm really interested in that. But first, kind of how do you see the role evolving in drug discovery and care provision?
Yeah. So let's talk about drug discovery first, because I think that's the area where if you listen to the layman's press or interviews with AI thought leaders, that's where most people kind of talk about. And to be honest, I'm a skeptic. Not to say that AI hasn't played a role, certainly in the early stages of drug development, where, for example, I need to optimize a molecule to bind this particular protein. In that use case, AI can be very, very helpful, and it's already being used widely. But the truth of the matter is that early part of drug development represents maybe 20% of the total cost in development. And so even if you got that more efficient by 50%, you've saved 10 cents on the dollar. So not to say it has no impact, but this notion that it's going to completely transform drug discovery, I think, has just been way oversold. And I think the second piece is that I will often hear from AI folks that, oh, well, we will pick drugs that are more likely to work in the end. So it's going to end up being way more efficient. And I always say, on what basis? What is the LLM data set trait that's being trained on that would give you any confidence in that assertion? Because the truth of the matter is biology remains exceedingly complex. Humanity has done is very early in the stages of really understanding the biology of most diseases. And so a notion that there's an LLM out there training on a data set that could give you that kind of insight, I remain highly, highly skeptical. So I think we're still a generation away from AI having a really meaningful impact on drug discovery.
And by a generation, what does that mean in terms of your guesstimate of timing for that sort of an impact?
For me, 20 years. I think it's a long time.
Oh, really?
Yeah.
Interesting.
So I'm quite skeptical. And look, I may be wrong. Obviously, AI progress in theory has been very, very quick. But I come to the data set that you have to really believe you had to train for me to incredibly believe you could do that. So, for example, if we actually had a system that collected the data on every patient, we knew what they were treated with, we knew how they did. But as you know, data on patients is a total mess in the United States. It's completely piecemeal.
Tremendously. Yeah.
No one has incentive to share. So to solve that data collection, I mean, my God, I feel like I've spent in the last 50 years, I think the medical, community has been trying to figure this out to no avail. So the notion that they're going to solve the data collection thing in the next 5 to 10 years to me remains, again, I think highly optimistic.
Interesting. So it's really the dispersion and legacy systems and patchwork of record keeping all over the place, and how the hell do you map that?
Exactly. And then you add on the fact that if you actually look at the public literature in science, it's actually well known that probably 30 to 40% of all published literature is just flat out made up, right? It's either fraudulent or more classically, it's if anyone's ever worked in a lab, everyone knows this. You do an experiment 5 times, you pick the one that went the way you wanted it to.
Right. So I noticed in your presentation, you talk about physicians and physician with internet, physician with GPT. Describe that progression, the way you see it, because I think that's on the care side of things, and it might be a bit different from the drug discovery side.
That's right. So I think on the delivery of care side, I think AI can have a pretty massive impact. And the study that you cited was they compared physicians and said, look, let's give them a test. We'll give them a vignette and we'll see how well they do in diagnosing the disease and then providing a treatment plan. And surprisingly, what they found is that a doctor with Google improved their performance slightly than just doctor alone. Doctor with ChatGPT only marginally so, which is actually surprising. But ChatGPT by itself outperformed everybody dramatically. And so, we are within probably 5 years, right, of chatbots being able to replace or be superior to the average physician in America.
So you quit medical school appropriately.
I think, unfortunately, I do tell my wife, who's also a doctor, I do say, I'm not sure I would tell her it gets to be a doctor at this point.
Do you have kids?
I do. I have 3 children, and one of them probably wants to be a doctor, but I think, let me put it this way, I think being a doctor will change in terms of what it means. So today, it's actually indexed primarily on brains, knowledge and skill. And actually, if you think about it, medical schools do not select on empathy and people skills. Unfortunately, we probably don't know that when we meet our doctor. But I think the next generation doctor may be different. But that's where I think you might say we should be selecting on empathy, not on knowledge.
Yeah. No, it seems that way. And of course, with demographics, the need for more medical services just going up. But I don't think the economic prospects for doctors, except for very skilled specialists, I think your GPs are going to be, getting a smaller and smaller share of the healthcare dollar. Now, you point out that drugs are likely to have an increase in the overall spend. Go through that rationale for a minute, if you would.
Yes, it's interesting. So if you tie what we just talked about, where the cost of delivery care should come down, right, as AI gets expanded, right? Because you don't have to pay a doctor $1 million a year anymore, right? You could probably hire a doctor for $75,000. Moreover, the notion of how you interact with the healthcare system will change. So, for instance, right now, I'm getting for most Americans, you don't really go to the doctor until you're quite ill because it's a pain in the butt, right? Hard to get to them. You get 10 minutes of their time. But if you had a ChatGPT chatbot, well, you could interact with that every day. You could talk about your symptoms and it could tell you, hey, I think you probably need to go in now. If there's something that you should go test for, here's the battery of tests. So long story short is that if you think about healthcare spending in total, let's say it's $100 a year. Today, only $10 is going to drugs. $90 is being lost in this incredibly inefficient system of delivery. So if you can knock that down and save, let's say, 30 cents, where would you put it? You'd put the number one thing that will impact our outcomes, to say, do you have cancer, are going to be the drugs that we get. And so I actually think a very strong argument that society should be spending much more on drug development. And that's going to have a much bigger impact on healthcare outcomes over time. So I do think there's an aspect of increased spending. If you think of all the other levers of healthcare spending toward drugs, it's demographics, which we know we're all getting older. And number 2, I would say it's the consumerization of healthcare. We're already seeing with GLP-1s, almost a third of all obesity drug revenues are being paid out of pocket, not by our insurance companies. So I think there is a greater and greater interest for people to take more control over what they do with their bodies, and they're going to spend more on healthcare and more on drugs, and I think as a proxy to that.
Yeah, no, absolutely. And particularly because the system does not always allow for a functional approach to diagnostic and treatment. And so you find these functional physicians who aren't accepted by the insurance companies or Medicare or anything. People pay them independently for their stuff. I do. I have a functional physician, and boy, they know me. And every quarter I go through a battery of diagnostic stuff, and it's really interesting when they can put disparate things together. And the popularization of this with Andrew Huberman and Peter Attia and Rhonda Patrick and all of these people is really, I think, a juggernaut for lots of folks.
100%. I mean, here's another thing to think about. If you were reading the headlines, you would think the debate on drug pricing is always drug prices are too high. I might posit the drug prices are too low. And let me say this slightly controversial statement. Here's my example. I would say if I was dying from cancer and someone said, okay, what is the price you're willing to pay for that drug that gives you an extra 6 months of life? The answer is everything I have in my bank account and more. Right?
Yeah, no question.
So the limit on drug pricing has never been actually like true full value. It's actually been a moral ethical question, actually. It's not a like full value question. And so I actually think the industry has been terrible at articulating that value. And the reason why is that most people do not like companies that have windfall profits, because it looks like someone making a killing, because no one sees all the failures, that they don't see. Right. So that's been the major limitation. But I think if the drug industry can start to articulate that value better and hopefully a more visceral, emotive way, I think that there's an argument that we should be spending more on drugs and actually being more accepting of higher drug prices. And that could come in the form of either higher list prices, but even frankly, I think more likely what I call top off reimbursement. So the idea is that governments would say, look, I'm going to reimburse to $1, right, for a treatment for cancer. If you, Tim, say, I want a better treatment that gives me another 3 months of life, I'm going to pay $2. So $1 comes from the government and $1 comes from me. And that incremental top off spending for that you allow the consumer to fill in themselves can subsidize for a lower price for the government, for example. So you could solve access for folks who are more moderate means by effectively having the wealthy subsidize the cost of drug discovery by incrementally taking more from them. So,
well, you could.
Yeah, I'm like, that's a theoretic argument. I'm not sure it'll happen, but that's a theoretic question, right?
Oh, well, yeah, it's true, though. I mean, and healthcare is a particular flashpoint for a bunch of different reasons. And it seems like sensible healthcare policy in the U.S. is extremely difficult. You take RFK Jr., for example, and, I think his heart's in the right place, but that's not enough. You got to pay attention to the data. They don't lie.
That's right.
And, his pogrom against mRNA vaccines is insane. And what they're doing at the CDC is nutty. On the other hand, should we be focusing on, lifestyle issues to tackle diabetes, lose weight, exercise, so forth? Should we be thinking about how ultra-processed foods are hyper-pallative and you eat way more than you think you're eating and just 200 or 300 calories extra a day, and pretty soon you look, fat.
Yeah, I think that's right.
And then you have the GLP.
Three thought that that's what they might have gone with RFK, meaning that he would spend his time on nutrition and things like that, where I think there's actually very high alignment, and instead it's not been the reverse. It's done nothing on nutrition and everything on vaccines and things like that, where I would say most of his views are not still not along the mainstream scientific kind of thinking.
Yeah, I think almost everything that comes out of Washington these days has a kernel of validity, and then it gets fucked up on the execution because you've got sycophants and whatever, people who are essentially unqualified for the jobs they've been tasked for.
One of the reasons why I think for that in particular is because when RFK was nominated, he required the support of a lot of Republican senators for confirmation, which were really in the Farm Bill. And the Farm Bill obviously is massively backed by big food, right? Because
Oh, yeah.
and so
High fructose corn syrup.
exactly. But that's actually, I think,
And ethanol.
that's the reason why he hasn't done anything on nutrition.
Yeah, it makes total sense. So switching gears a little bit, you mentioned biotech valuations being kind of in the tank. They have for a few years now. What do you see as the indicators of a turnaround in that? In other words, is it going to take a blockbuster or something? I mean, GLP, you would think Novo wouldn't be laying off 5,000 people or whatever they announced this morning. So what's it going to take to have people begin to recognize what's going on here?
Yeah. So, I always start off with fundamentals, which is what is the foundational value of biotech? And I always say it's the discounted cash flows of drug revenues. That's the source of all value in biotech. And that has continued to go up and to the right, been as steady as it can be for the last 20 years. So we know the foundational value of biotech is essentially unchanged. So really, we are in a situation where it's I think the market value has been suppressed by almost like a perfect storm of things, ranging from obviously high interest rates, which is obviously challenging for a long duration asset class like us, as well as some of the things you mentioned before on the political turmoil around RFK and the tariffs and all these sorts of things that all, of course, impact sentiment. And so part of the reason we're kind of excited, frankly, is that we love it when the foundational or fundamental value is still the same, but the market value has declined for non-fundamental reasons. So
until the exit.
That's right. Exactly. We love bubbles as much as anybody, but I think until you see interest rates come down meaningfully in a stable way, I don't actually think biotech is going to rip. So it remains somewhat of a specialized market, and it will stay that way where, smart people are going to smart trade with other experts. And really, honestly, you don't see bubbles in biotech until the generalists spun it.
One trigger event might be a decrease in interest rates. Well, 25 basis points probably won't do it. It's probably closer to 50 or 75 before the effects really start showing up in portfolios. Don't know if that's going to happen because we've baked some inflation in with helicoptering money to people and expanding the Fed's balance sheet and giving tax breaks and not increasing taxes. And so it doesn't look to me like we're going to get rid of those inflationary pressures anytime soon. So if interest rates don't come down significantly and you still have the foundational value here, how do you realize that value? There's obviously a dialectic here between the public and private, so perhaps you could go into a little bit of that. I saw you have some unusual monetization paths that I think are really interesting because it's not just selling your stake to somebody else. There's all kinds of transactions involving royalties and partial sell-offs of this and that, and this molecule you can have and this one you can have. Explain how that works.
So we do. So our firm, to some degree, is kind of a bit known for using structure in more creative ways to try to generate that maybe improve risk reward profile. So, for example, the most obvious ones relate to, for example, we do have royalties. For example, we have done equity deals where as part of that deal, we get a 2% or 3% royalty on the drug. We've done structures where we actually take essentially preferred dividend. So if the company generates actually operating cash flow, we'll be sweeping all that excess operating cash as a way to get our return. We do things like tranching where we, of course, give capital upon positive data. That's essentially reduce our risk, but hopefully preserve our reward. And in public deals, we'll often get warrants and discounts. We'll often get preferred looks at data that are not yet publicly available. So all these different, I call them bells and whistles, are ways for us that I like to say, put the thumb on the scale a bit and improve our risk reward against the average investor. And so that's probably why, for us, we have to lead our deals. We actually can't follow very often because if we aren't getting all these bells and whistles, we're just losing a big chunk of return opportunity. And so for our fund, right, our view is, look, if we can't get some special angle, then why do it?
Right. Maybe you could give an example of sort of the structural creativity you've had with a couple of these deals? I saw in your deck, I don't know how you pronounce it, Alkeus, is that right?
Yeah.
And Patholus. Those seem like two examples where you did some interesting stuff.
Yeah. So maybe I'll use Papples because I think it's the most creative. There's a company where the company has completed a phase 3 trial. It's actually going to file now for approval in the next 12 months. And once it gets approved, unusually, we essentially take, as I mentioned before, all the excess operating cash from the company that they launched the drug. So instead of us trying to necessarily depend on an IPO or an M&A event, as long as it goes and launches successfully, we're going to make a pretty attractive return just by sweeping that excess cash. If you think about it, that's almost more like a classic P kind of playbook, right? It's not the usual venture playbook. It's actually more of a PE playbook. And it's rarely applied, right, in biotech. Because frankly, most companies end up just selling, right? They never actually bother trying to launch. This one was a little unusual because it's launching in a therapeutic area where there's not a lot of strategic buyers. And so we essentially assumed that the base case was we would have to launch this drug. So those are sorts of things where, again, as I think of, I try to stress to people, if you're investing in biotech, you often have this notion that you're investing in this very high risk binary event. And if the trial fails, you have a zero. This is a case where we actually invested in the company basically after we already knew the drug was going to work. It was already approved. So the risk profile is completely different, yet we can get a venture-like return by using the structure.
Right. So when you're dealing with these management teams, in many venture situations and buyouts and growth, for that matter, the owners have to step in from time to time and change teams, and often replacing C-level folks. And as companies grow, this is standard operating procedure, because some people who can start companies aren't the ones to drive them to several hundred million, and several hundred million doesn't go to a billion, and so forth. So very common practice. However, in biotech, you've got these scientist entrepreneurs, these researcher entrepreneurs. It seems to me that a lot of your bet is on the technical capabilities of that team and their underlying vision for what they're doing, what they've done before, where their expertise, where their vision, where they're able to synthesize a variety of macro and micro elements that other people can't, because they've got this domain expertise in this specific little thing. So how often do you change any of these teams? I would think they'd be difficult to replace, maybe impossible. And it's primarily a kind of research and data-driven thing. Maybe there's some personality issues or something where you might have to get rid of somebody. But how does that work? How often do you change management in portfolio companies, or have the ability to? Because if you're a minority investor, sometimes you don't have that influence.
In most biotechs, there's kind of a two-headed monster in the sense that you usually have a CEO whose primary job is to summary business development, right? Getting financed, but also selling to strategics and other investors. And then there's the scientific founder that you kind of described. That scientific founder is very hard to replace, almost impossible, because, they're the ones who know everything, right, around the actual technology. But the other piece, that financier, the storyteller, that piece I think can be changed and often can have high impact. And so I would say, look, it doesn't happen that often. In our portfolio, my guess is no more than 10% of our portfolio. But we certainly do that. And we have, we take board seats on our private companies, and we certainly have had situations where we've had to do that. But look, in general, if you're investing and the team is not, there, you're kind of signing up for a pretty obvious risk. And then that's definitely a failure mode in our business.
Yeah. So you have your commerce guys and your science guys, gals, and it's kind of two teams, really, almost.
It is. That's right. So I actually can't think of a time where we've really replaced a technical founder.
That's what I would think.
Yeah, it's very hard.
I mean, you go to a George Church deal, for example, you're not replacing George. That's
right. Exactly. Or, apparently, if you're trying to replace a technical founder, something has gone terribly wrong.
Yeah. Well, your diligence failed, essentially, because they're not the right people for, what you're pursuing. How do you leverage the difference? Maybe even arbitrage is the right word, between the public and private sides of the portfolio. How do you get the information synergies, and how does that work?
Yeah. I mean, that's actually one of the great benefits of doing both, because obviously most successful private companies eventually become public companies. And so when we see these companies on the public side, oftentimes we have longitudinally followed them for years, even when they were private. So we know all the things they promised, 5 or 6 years ago, and we can see if that's actually mapped to reality. In addition, as you know, in private companies, you have full access to data. You can see literally patient level data, for example. And in public markets, you have much more limited data disclosure. So the fact that we can actually get that kind of data transparency early in their life cycle, it can be very valuable. I mean, it can be as simple as we can look at detailed toxicity reports from animals in the private company. So when we see something publicly, we can actually connect some dots that most other investors can't. So that's a huge advantage of being in both. In terms of like moving back and forth with risk reward, for us, we have a gestalt of what is good value. And I like to say it's whenever the DCF value is way higher than market value, that's when we want to pounce. And we just look at the biggest spread we can, and we just don't care if it's public or private. So,
yeah. Well, discovering where that foundational value is and then measuring it is harder than the market value, because the market will tell you what the value is.
Yeah.
The foundational stuff, you guys have to figure it out, right?
That's right. That's a little bit of the secret sauce of our business. And just having been around for 20 years and knowing when do we feel like we actually are seeing a drug? That's what I always like to say. Like, is this a drug? Mm-hmm. And that, as you know, it's an art, right? You have data. I'll give a simple example where you have data that says, oh, look, it actually is efficacious. But then the question is, well, is it efficacious enough? Is it actually going to be differentiated against other therapies, not only that are there, but will be there in 10 years? And that's a little bit of the art.
Yeah. Is it sufficiently importantly differentiated? That makes perfect sense. So, what lessons were learned from the recent IPOs that outperformed consensus? I mean, the weight loss drugs or the CG oncology stuff.
So it's interesting. We actually I happened to be reading a industry report about a week ago, because I'm preparing for our own annual meeting. And I looked at all the IPOs in 2023 and 24. It turned out more than 80% of those IPOs are negative, meaning almost everything lost money in the last 2 years. We happen to be in the ones that won. Now, what's interesting is, how is that? So I said, well, why were we in those ones and not the others? We were very focused on what I call just fundamental drugs. We actually didn't do deals where there was a lot of narrative or sexy science, or companies that were started by famous folks like a George Church, right? Like, we didn't invest in just like the fact that it was a fancy founder. That didn't play into our thesis. It was just like the data we're looking for is this a drug? And so I think in tough markets, one of the key lessons is, in tough markets, the things that work are drugs. No one cares about sexy science in a bad market. So that's one.
Fair enough.
The second is actually how deals were done. So I have this is a little bit of a rant for me, but if you look at the IPOs the last 2 years, what bankers would go, they would tell companies and say, look, your insiders have to back 100% of the IPO. So the book's fully covered by the time we go out, because you need to support it in a bad market. Well, if you think about it, not surprisingly, that meant you artificially inflated the price by insiders. And when you went out, there was no external demand. So why are we surprised that the stocks went down? What if instead you took a real market price? You actually did a real market price discovery IPO, where you went to the market and said, look, you tell us what we're worth. And so LB Pharma was a company of ours last week that went out. It essentially followed this playbook. It was a down round IPO, right? So it was down below our private mark, but it raised $285 million, the largest IPO of the last year or two. And so I think it showed you, like, the market is actually there. We just have to do it the right way.
Interesting. So that one, obviously, you don't get liquidity on an IPO. It just gives them access to more capital, and now they're publicly registered. How long does a hold typically last post IPO in a situation like this?
We typically hold our investments for roughly on public side, our average hold time is about 16 to 18 months.
Okay. So you trade out when you can.
Well, mainly because once it goes public, usually we're financing some kind of catalyst, and usually that catalyst happens within 18 months of that IPO.
Right, because the timing of the IPO and all that was baked in. Yeah. So some interesting stuff going on with China, and found that fascinating to read about. So talk about that a little bit, the changing geopolitical environment and how it affects the approach to sourcing and structuring Chinese biotech deals.
Well, what's been very interesting in the last 3 years, we went from basically having very few drugs from China coming into that, so the innovative market. And so just as an example, pharma, last year, 40% of all the molecules they brought in were from Chinese companies. That was 0% in 2019. So
wow.
Really. And in fact, when we attend these medical conferences, there's a cancer conference called ASCO, which is the big cancer conference of the year. And we informally would track how many of the most interesting abstracts were coming from Chinese labs. And again, 5 years ago, it was roughly about 5%. And this year, we felt that 40% of all the most interesting abstracts in cancer were actually coming from Chinese labs. So I think we are now in the full realization that China has essentially caught up. And now it is, clearly challenging the U.S. in terms of technical dominance and biotech. So the question is, who wins and who loses with that dynamic? And what's interesting to note is that pharma and late-stage investors are winners because for us, right, it's just a cheaper source of innovation. And that's great, right? And so for pharma and for late-stage investors, China's rise is to some reason a boon. But if you're an early-stage biotech investor, and you're saying, wait a minute, it takes me $40 million to get proven concept, and the Chinese company is doing it with $8 million. Well, now you're in trouble. So it's actually a very big threat to early stage venture biotech companies and investors in the US. So it's a winners and losers thing. It's not a cut and dry like it's good or bad for America. It has different constituencies that can benefit. In the long run, you may have noticed just even 3 days ago, there was a report that Trump was thinking of an executive order that could potentially really restrict Chinese assets coming to the US. And I think, again, it would be a long-term negative for the industry because, as I said, it's in our industry's interest to reduce the cost of drug development. Because as those costs come down, we can have lower drug prices for patients. That's a good thing for humanity, right? And so I think we should try to find ways for that to continue to flow. And I would rather us reduce our costs here as opposed to try to block Chinese innovation.
It's so ironic. For decades now, the Chinese have kind of been doing that with us.
Yes.
They've been using our technologies for various kinds of things and to our benefit as well as theirs. So I having taken a master's in international finance many years ago, understanding comparative advantage, I completely agree with you. And basically, it's the Chinese government that's been funding this stuff. So, I guess it's one of those situations where if we can make lemon out of lemonades, or lemonade out of lemons, you really have to do it, particularly since it's become so strong.
Just to give you just a sense of the stats, it takes a Chinese company roughly a third of the cost to get to the same place. They can do it in half the time. And so you start to realize that if we don't improve our efficiency at the early stage, it's going to be a problem. I'll just give you another, again, more of an anecdote. A U.S. biotech CEO gets paid roughly $850,000 a year in cash and has a 12-month severance package. And you start to ask yourself, does that sound like a startup to you?
Well, what challenges do they face? They've got these opportunities with lower costs and government support and all that stuff. What sort of unique challenges might the Chinese biotech innovators face?
Well, Chinese don't have as mature a capital market as we do. So their venture market is much thinner. They don't have a very robust public market that can support development stage companies. So they don't really have a NASDAQ equivalent of ours for biotech. And that's been the major limitation for them. But I think what you're going to see, right now, if you go to Hong Kong, the IPO market is absolutely ripping. And I think if this continues for the next 3 years, you're going to have a pretty robust capital market in China that could be competitive with ours. And so again, it is becoming clear the trajectory there is in the next 5 to 10 years, if things go the same way they are, China will be, if not at par with the US on biotech development, it could even pass us.
Yeah, I think A shares are now pretty much the only place Chinese investors can put their money because real estate, of course, is, a complete disaster. 150, 200 million units unsold and not even fully constructed. So if there is an avenue for Chinese investors, and the Chinese are also known for their gambling proclivities. Take a look at Macau, which is, I don't know how many times bigger than Las Vegas. But, I think you're going to see a real change. Now, will the government allow that? I haven't any idea. But Chinese money is looking for ways to make more money. No question.
Yeah. Well, it's interesting. If you think about the government support for biotech in China, it's actually been relatively limited. It's not like tech, where in actuality, they have done, I would say, generally speaking, the Chinese government has actually been fairly hostile to biotech. And the reason why is that they don't want to pay higher drug prices. And the number one driver of higher drug prices is actually innovation. Because when you get new drugs, that's when you get higher drug prices. The funny thing is, this boom of development has actually not been driven as much by the government as you would think. It's actually been more these private entrepreneurs of just incredible energy. And I like to say, I actually spent some time working at a Chinese company in like 2009 to 2012 timeframe. And I think I might have told you the story, but it was February. Everyone in the office was bundled up in coats and hats. There were no lights on. And the reason why is that they were saving electricity and cost. And you start to think, would any U.S. company ever even consider doing something like that? Right? No. So it just shows you like the intensity of work that is like just not really, we just don't see it in the US right now, especially in biotech. And I think to some degree, the boom era of 2013 to 21 made the US biotech and kind of sector a bit fat. Like companies were just getting used to being paid high cash comp, maybe working as if they were in a pharma company as opposed to a true startup. And I actually think one of the things that we have to do as a sector is we've got to relight the fire of entrepreneurship in biotech in the U.S. That is, we got to get more equity as opposed to cash. We got to work harder.
How do you do that?
It's a great question. I don't know. I was actually debating this with another venture investor just today. I saw the article in the journal today, or maybe the Times. They talk about how AI founders in San Francisco, they're just working 90-hour weeks. We don't do that in biotech, right? We have to develop that. Right, that's the ethos we've got to have, or we're actually going to become less competitive against China.
What do you think of the Chinese demographic situation? If you've been sort of paying attention to demographics, it seems we know, or we think we know, that the Chinese population is maybe 200 million smaller than the government claims. We also know that the one-child policy and infanticide of female babies has, compounding works in the other way too. A compounding curve, right?
It's going to be an incredible experiment where the world's going to watch and learn. And because obviously every developed nation is facing some flavor of this problem.
Oh, yeah.
Right. My sense is, and this is where I'm going to go over my skis, but I do sense that this is where AI could have a pretty dramatic impact. If you have improvements in productivity from robots and AI generally, the demographic shift may end up being less of a big deal.
Yeah, no, I think you're probably right, particularly as it moves out. We moved from LLMs to real world models, and inference happens at the edge, which is, I think, where we're really headed. So what kind of companies and technologies are you most excited about for this new fund you've got?
Yeah, it's very interesting. We are, as I said, because we're fundamentally driven, we are less enamored with any particular modality or approach. I think for us, we are just actually much more interested, maybe to your earlier question, around process. That is, we think that the next really big innovation that would have high impact is actually improving the regulatory and process by which we get drug approved. Because, for example, one of the big changes that we could make is, instead of requiring all these companies to do, 2 animal species of testing, all this mechanistic work before we even tried in humans, well, what if we just tried it in humans and save years of time, right? And now it sounds crazy, but this route is I use cancer as a great example. If you're dying of cancer, are you interested in trying a new therapy? The answer is absolutely. It's very difficult in the US to even try those new therapies. And so my view is if you could accelerate the entry into human testing and we could actually just tell the difference, it would be a huge impact on efficiency. That's just one example. And so that's really what I think is the most thing I'm most excited about is, can we improve the efficiency of the process?
My wife was a senior accountant with Icon Clinical Services a few years ago. She and the rest of the people in the receivables team, because that's where she was, would laugh like crazy when some of the trials they were doing in Eastern Europe were publicized. People, and it's exactly this. They're not doing animal trials. They're like talking to people in Croatia or Poland and doing stuff to them with their permission. But I think you're right. That's going to be very interesting to see how that happens. I'm not sure. I think it may be another one of those insolvable problems, like the working harder and more entrepreneurial stuff. I think, fortunately, the U.S. has more of an entrepreneurial spirit than many other developed places. And California particularly has this in spades. But I think you're right. The work ethic is not what it is in China. They've got so many people competing with each other. And it's a different world entirely. So wrapping it up here, what advice would you give to aspiring biotech founders at this point in terms of how they should be approaching building their business?
Yeah, I actually tell people, as you can probably hear, the being a dead horse, which is if you stick to fundamentals and think about the fastest path to seeing if you have a drug. And so, for example, I always say, do the definitive experiment. Don't try to dance around it and hide and try to sell stories, do half experiments that maybe will make you look good, but don't actually answer the question if you have a drug. Just answer the question. And I'm not going to blame you if you're wrong. But I will blame you if you take the long way to the right answer. And so that to me is what I always tell people. Just figure it out as fast and quickly as you can. Because otherwise you'll spend 10 years of your life chasing a drug that never was there.
So be very practical about the implications of what you're doing and the likelihood of being able to actually succeed. Not just because it's intellectually interesting.
That's right.
But because there is actually a pot of gold at the end of the rainbow.
That's right. And that sounds obvious, but you would find, I'd say the majority of companies will often do clinical trials that don't actually put them to the hardest test. They actually try to pick an easy test. So they want to look good for an investor. But in the end, after you do the experiment, you actually don't know for sure if you've got a drug. And so for me, those are great wastes of time and money.
Yeah.
So that's what I tell them.
Well, with your experience, you can tell the difference.
In theory.
Between the easy ones and the hard ones. And that's the thing. This is, you need domain expertise to play in this game. I mean, you really do. And the more you have, the better you're going to be at it. At least that's my impression.
It is. I think it's true. I think in this space, you have to be a specialist.
Well, Chen, this has been fascinating. I really appreciate it. And I'd like to do it again at some point after we've seen what happens and some of your predictions have probably taken place. But it's been a pleasure, and I really appreciate your coming on.
Well, Tim, thank you so much for having me, and I appreciate the really insightful questions.
Thank you so much.
Take care.
Thank you for listening. Please visit us online at touchstonegroupllc.com.